I'm going to go ahead and start that now. But thank you guys so much for joining us for our final session of Money Smart Day 2024. We're super glad that you decided to join us for this fun session on mastering financial foundations. We have two guests here to present for us. First, we have Nicolette Davasino. She is a certified financial planner and an enrolled agent at Armstrong, Fleming, and Moore, a 40-year-old financial planning and investment advisory firm in downtown Washington, D.C. Nicolette graduated from George Mason, class of 2017, with a BS in economics, and honed her expertise prior to joining the industry by drafting research on financial services regulation as a fellow in the United States Senate. She currently serves as a volunteer with the Washington School for Girls and is a next-gen member on the Costello College of Business Financial Planning and Wealth Management Board. We also have Nicholas Gaidos, an investment professional with VLP Financial Advisors. He assists with developing astute investment and financial planning strategies for individual and corporate clients. Nicholas holds a pivotal position on VLP's investment committee. His role encompasses in-depth market research, meticulous due diligence efforts, and ensures that all decisions are backed by thorough analysis. Nicholas graduated from George Mason University School of Business with concentrations in both finance and financial planning and wealth management. Nicholas currently serves as a next-gen member on the Costello College of Business Financial Planning and Wealth Management Board as well. And I'm going to pass it over to them to get started. We do ask if you do have questions to hold them for the end, and we will ask, you can send them in the chat, and we will ask them and address them all at the end of the presentation.
All right, well, thank you for the lovely introduction. Welcome, everybody. Hopefully don't keep you asleep at this time of the evening. So to get started, here we go. So title of our slide is Managing Financial Foundation. So our goal here is to kind of cover some basics of investments, retirement planning, estate planning, and just general best practices and ideas and certain subjects that you may not think of when preparing your own personal finances. So starting off with investments, why invest in the first place? A couple points: take advantage of compound interest. What's nice about compound interest is, say if you invest $100 into something and you make 10%, you'll have $110. You get another 10% the next year and go up to $121 essentially. So it keeps compounding on your initial investment, which is nice. And it kind of ties in the idea of having your money work for you. So instead of working for an hourly wage, it essentially grows through the market. And then for inflation, it can aid in counteracting the effects of inflation. With inflation, it can degrade the purchasing power of your cash. So by investing, you can counteract that because, anyone with grandparents, they'll say, oh, I could buy a car for $250 back in the day or something like that. And we're like, yeah, it's not the same case now. That's essentially inflation and purchasing power. It also helps you diversify your assets as well. So moving forward, I'm going to dive into this idea of concentrated risk. So whether it's stocks, bonds, ETFs, or mutual funds, it's generally recommended to not be too concentrated in one investment. And the reason is, if you're only in a few select stocks and the stock market isn't doing well, you could have had a allocation to bonds to where they may not be down as much, or they could potentially be up. So generally speaking, it ties into that idea of don't have all of your eggs in one basket because, one area may not be doing well. So if you're spread out more, it's better. And diversification is recommended because it captures the average of a variety of securities in the market. So, a big stock everyone's talking about right now is NVIDIA. You don't want to just be in that stock because if it crashes down really hard, and say if it's a brokerage account that you have for savings 10 years from now, if it goes down to zero, which probably wouldn't, but theoretically it could, that wouldn't be a good thing. And this starts tying into the idea of asset allocation. Okay, between, stocks, bonds, ETFs and such, how should I allocate my portfolio? And it's all going to depend on the comfort of risk or how comfortable you are with risk in general. So just to tie back a little bit, so just covering what each one of these different investment vehicles means. So for stocks, it's pretty much a representation of units of ownership in a particular public company. And then for bonds, it's essentially lending money to a company, government, or municipality, usually in exchange for periodic interest. So essentially, say you give $1,000 to a company, they'll pay something called coupons. They're called coupons because back in the day, you'd rip a little coupon off of a sheet of paper and exchange it for an interest payment. Nowadays, it just hits your investment account. And essentially, the goal is collect the interest payments, and then once the bond matures, you'll get the original face value, which was that initial, say in this case, $1,000 you put in. You'll get that back as well. And there's other risks associated with it in terms of how long the contract is for maturity and when you'd get your money back. And for ETFs, they're pretty similar in some ways to mutual funds. So essentially, it's an investment fund that trades on a stock exchange. So there's S&P 500 index ETFs, there's international ETFs, there's very broad categories similar to mutual funds. And for mutual funds, they're investment vehicles that pull money from many investors to invest in a portfolio of stocks, bonds, and or other securities. And the main advantage and why mutual funds and ETFs are very popular is, say you want to have a collection of 100 stocks. We'll say some of them or most of them are $500 a pop. If you're just starting out in investing, it can be pretty hard to just have that money up front to load it in. So the advantage of mutual funds and ETFs is that it's a pool of all these different securities to be diversified, but it's a lot cheaper, generally speaking. Some of them can be a little bit more expensive than others, but a good amount, like personally me, for some ETFs I personally use, you can buy them for $50 to $70 a share and you're pretty diversified. All depends on which one you're looking to invest into, but it's a great way to diversify. And when purchasing a mutual fund, it doesn't trade on an exchange like a stock. That's going to be more like an ETF. A lot of other things with technicals you can go into, but generally speaking, that's the baseline for investment vehicles. We're not going to dive into private equity, private credit, hedge funds, or derivatives. It's complicated stuff to where if you're interested in doing that, I'd recommend consulting a financial professional to guide you through the proper usages for those different vehicles. And so understanding some basic investment metrics, this is going to focus on kind of risk and performance. We have standard deviation, which is pretty much the volatility of your investment. Sharpe ratio, which is a risk-adjusted investment performance metric. So essentially comparing how much return to the amount of risk you're taking. And then alpha is the amount the fund has over or underperformed what the fund was expecting the fund to return in a said given period. And then the beta, you can kind of think of that as a correlation to a benchmark such as the S&P 500. It's at a beta at 1, the market moves up 1%, it's going to move up 1%, 1.5, it's going to be 1.5 times. Same thing with negative. You can have a negative beta to where stock goes up 1% and your investment goes down, and vice versa. And so with these, one thing that's important to remember is you can't compare them apples to apples with every single fund out there, because you could have a fund or a stock that's in healthcare. Generally speaking, a certain category like that, such as healthcare, is going to have pretty much a similar area of where healthcare is going to lie for standard deviation, risk and performance. Technology, kind of the same thing. You want to compare those metrics to those categories, just because with more growth investments, the investments are going to swing up and down a lot more than compared to, say, something like consumer staples, where it's goods like Procter and Gamble, where it's stuff you buy constantly at the grocery store. So they're good things to look at, but just keep in mind, try to compare those relative to whatever sector you're looking into. And then on the right here, it's a picture that's called the CAPM model, which is capital asset pricing model. It essentially shows in a graph how people like to pick out portfolios. And so on the up axis, you see the risk-free percentage, which is essentially based off of the 3-month treasury bills. And that's pretty much given of investment-free risk is what people like to call it. And then towards the right is going to be your expected risk. Essentially, that U curve is a ton of different portfolio allocations of, say if you have 5 investments, what percentage do you want to have of each? And it pretty much creates a curve. And then you have your risk-free investment going up like this. And pretty much at that tangent point is typically the most optimal place, because that's where you get the best ratio of expected return and risk. So you're not too much in risk or too little. And it doesn't always have to be that way, because if you're more of a conservative investor, maybe you want to be on a different end or different allocation to where, you want less risk because you can't handle big drawdowns. And there's nothing wrong with that, because at the end of the day, when you're investing, you want to be utilizing compound interest, but not in a way to where it keeps you up at night. So moving forward, so going more into equities, because that's usually a more popular topic than talking about bonds, because they're viewed a little bit more boring, but we'll move on to that in the next slide. But for equities, a couple of things that are important to consider, mostly with ETFs and mutual funds, is fund manager tenure. So essentially with these funds, you have your fund managers. And one thing that you usually like to see are that there's not a lot of turnover in the fund managers, because if the fund managers are completely hopping in and out, getting different people constantly, it's hard to tell, if they're sticking with the same method or not, because certain funds have certain philosophies, and, everyone's going to be a little different on how they view what they should buy or sell. So the more consistency they have in that, typically the better. Not always, but typically that's something we like to look for, is making sure there's not a lot of turnover there, because the more consistency and the methods and the people, the better. And then for style blend, this is getting into, if you've ever heard of large cap, mid cap, small cap on the top right box, stock style exposure. It's also called blend. Pretty much breaks down the size of the companies. So like large cap, you're going to think of like Apple, Amazon, Nvidia, really big companies. And then as you go down, the smaller companies. And essentially, it's also a good way of looking at risk to a certain extent, because typically the larger companies, you're not going to have to worry about them going bad in a big market downturn. Small caps, you're going to be a little concerned in a bad market condition. But at the same time, you can appreciate more long-term, because historically small caps have been shown to outperform. But at the end of the day, having a nice balance between everything is always a good thing. And for asset turnover, this is important for whether or not you're having a regular brokerage account or if you're putting money into a 401k or an IRA. Because essentially what asset turnover means is how much they're buying and selling. So if you're in a mutual fund, a lot of times when they sell out of positions, the capital gains actually gets passed on to you, the investor. So if they're constantly buying and selling stuff, that can actually affect your taxes. So in that case, if it's a regular brokerage account, that may be something you want to be aware of. And then for geography, this is more getting into if you're doing global or international. Global funds are typically, they have a chunk in US and the rest of the world. International is solely everything outside the US. And so the geography is a really big component, because depending on currency exchange rates, political stability and such, pretty much anything that could happen in another country between the government and the economy, those can all be different risks. So typically what you want to do is be aware of where it's being invested. One thing you'll hear about is emerging markets investments. Those are typically international investments that are going to be a little bit more risky, because they're not as stable or as established as other countries per se. So that's one thing to definitely be mindful of. In the bottom left chart here, kind of shows you a breakdown if you have a fund, what it could look like. In this case, we can see that it's mostly North America, so it's not an international investment. And for sector allocation, if you look at the bottom right chart here, kind of breaks down the different sectors that the fund is in. And this is pretty important to look at, because say if you're in a fund that's mostly in, say, technology, and you're wondering why it's a lot more volatile than, say, another fund, well, the sector breakdown can help you understand the fund a little bit more and why, because technology, for instance, is known to be a little bit more volatile. And so in this case, we have 3 different categories: cyclical, sensitive, and defensive. And it pretty much breaks down, the industries within: basic materials, real estate, industrials. So different areas that they invest in. And so when you're looking at certain funds, some of them may be more tech focused or healthcare focused. There's nothing necessarily wrong with having those, but overall, I'd say if you want to invest long term and just be diversified, make sure that there's not large skews in one or the other. So if you're looking say if you're unsure of if something's unscrewed or not, you can always go to a benchmark such as the S&P 500 or Russell 3000 and kind of reference where it's at to make sure that you're not too exposed in one set area. So moving on to bonds, more of a popular thing, especially with where I work, we're more into mutual fund bond funds than just buying actual funds. And it makes it a lot easier because the bond market can be a pretty complex place if you're not familiar with it. But these four metrics will help you understand bond mutual funds or bond ETFs. So one thing is duration, and it pretty much measures the bond sensitivity to interest rate changes. As a lot of you may be familiar, within the past 2 years, there was a lot of rate hikes, and now there may be some rate cuts. And so interest rate hikes or cuts can affect a bond. So the duration kind of measures the sensitivity to that, which you may be wondering, okay, well, how does that affect, or how does duration come into play from that? It all depends on how long the contract per se is until the bond matures, as well as how much interest it's paying. So typically the longer out it is, the more sensitive it is, because say if you bought a bond that's, matures in 10 years and it's paying 2% interest, well, rates go up and say you can get 4% now for 10 years, that's going to be worth a lot more than what the 2% is. So the value of that bond's actually going to go down. Now, depending on credit quality and as well as coupon payments can change that as well. And for yield, that's typically the return on investment annualized, kind of plays into a little bit of how much it is the bond itself is paying versus the price of the bond. And for credit, it's pretty much the borrower's ability to repay the debt. Most cases, company, if you're looking at corporate bond funds. And so for this, if they don't have great credit quality and the market goes sideways, that can be a risk. So typically, if you see something with lower credit, it's going to pay more in coupons. But you have to understand that, you are taking more risk, and that's why it's paying more. And for sector, this can also come into play similar to equities, depending on where it's at, can change how much it may pay, because different industries do things a little bit differently. And I'd say, to wrap up the bonds and mutual funds, a lot of people say, what's the point of even investing in bonds? Maybe if you're younger, you may not have a reason to, but typically before you start distributing or you're in the phase of distributing assets from your account, what's nice about bonds is they don't swing it around as much. So you can still get some interest, or not interest, but some return, hopefully, and it not swing around as much as equities. And I'm going to
Nick,
pass it on
thank you.
to taxes.
That was a great intro to different types of investments and the different vehicles of investments. And what Nick had already touched on is that some of those investments are taxable. And that was and also please bear with me, I'm a little sick today, so I'm doing my best. But on our slide here, we have some of the topics that come up the most in my work as a tax professional. I'm an enrolled agent with the IRS, so the federal version of a CPA. Again, I just have some basic definitions on here. These are things that hopefully, being that it was just tax day, everyone on here is fairly familiar with, or at least just worked through recently with a tax pro. But yeah, we'll dive in a little bit more on our next slide. And so I like to start with these concepts of gross income and the adjustments to gross income. Gross income represents your total income before any deductions or adjustments. It is all sources of income, exactly what it sounds, gross, the total, and includes, your wages, interests, capital gains, if you rent out, an extra bedroom in your house, if you rent out a vacation home, that rental income, certain types of government and military pensions, as well as some, but not all, retirement plan distributions. And then on the other side of that, your gross income is what your starting place, but then it actually becomes your adjusted gross income, which is the far more important, and honestly the metric I recommend everyone gets a little bit more familiar with when you review your own tax return. Adjusted gross income is actually the number that is used by Congress to set those parameters for various tax breaks. And so it's very important to know where you fall. AGI specifically is derived from your gross income. So all of that, income that is coming in on the other side. However, then you subtract specific adjustments. And we call those above the line deductions. I hear this a lot in tax prep and also in tax planning, where people ask questions about my above the line deductions, and then nobody ever asks, where is the line? AGI is that line. So anything that is deducted above AGI is your above the line deduction. Those are subtracted directly from gross income, and that helps you get to your adjusted gross income. These are very valuable because they can impact other deductions and credits. I have some examples here of what they can be. One of the most popular ones is that if you've paid student loan interest, you can deduct up to $2,500 from your AGI, as well as, there are educator expenses for teachers, health savings account contributions for people who are contributing to HSA accounts, certain retirement accounts as well are included in there. And then I just have our general calculation for AGI on the bottom. There are also below the line deductions. And so those are not always called that. I think most people are more familiar with them by their other two names, which are itemized versus standard deductions. These deductions come into play after calculating your AGI and after you calculate any tax credits you're eligible for. I tend to focus less on below the line deductions when we talk generally about tax returns because they're very, very dependent on where you fall as a taxpayer. Most people take the standard deduction. However, if you have certain specific expenses that exceed the standard deduction, then you are permitted to itemize with the tax code. Itemized deductions include some expenses like mortgage interest, state and local taxes, charitable contributions, and medical expenses. And all of these things, can tend to tie in, but are again very specific to an individual taxpayer. But since most people are probably already fairly familiar with these terms just by preparing their basic tax return, we did also want to revisit one that often gets overlooked. So Nick, if you will switch to our next slide, I wanted to touch a little bit on taxes that people don't even think about paying. I think most people have thought about paying their taxes recently, again, just passing the 415 deadline. But I think there's a whole set of taxes that get overlooked, and those are the taxes we pay automatically that are withheld out of our paychecks. Most people who work as an employee has a federal paycheck. And so that is where your employer deducts, your taxes before you even receive it. It is not always the most popular part of our tax system, but it is entirely critical because it ensures that you pay your taxes throughout the year, which then, ensures that at tax time, so April 15th, you don't end up with a massive lump sum that you owe that you have to pay back to the government. The goal with paycheck withholding is actually really to match your withholding to your tax liability. It's complex, it's very hard to do perfectly, but we try to guide people to do it as close as possible, so that you neither owe a large amount nor receive a substantial refund when you file your tax return. And so a little bit about the W-4. The W-4 is the employee withholding certificate. Everyone who's starting a job, so if you're about to graduate, you start a new job, or if you're changing a career later in life, you will fill out a W-4. I also like to emphasize that you don't just fill out a W-4 when you start a job. You can actually go in and adjust it for any type of significant life changes. So for anyone who's getting married, maybe having a child, maybe having another child, that is when I would also recommend going to check on your W-4 withholding with your employer and maybe adjusting it, maybe increasing it, maybe lowering it. And so there are some key components of the W-4. I again have the process down here, but some key components to be aware of on that are your filing status. Again, this is what changes if you are single and filing your taxes, and then you get married. All of a sudden, your filing status is married filing jointly, and so that's another thing you would update on there. Allocation allowances, which you indicate the amount of allowances you would like withheld out of your paycheck, and also you can specify additional withholding. That additional withholding piece is what is critical for people who are maybe working another job. They have some extra income coming in from a side hustle. You sold some clothes on Depop and made $1,000. That is where that additional withholding comes in, because it is how you can protect yourself and balance out any of the other income that you're earning that is not being taxed through withholding. Some resources if you'd like to check your math on this, because again, it is very difficult to do it to, the exact dollar amount. I always recommend that the IRS has a really, really great tool. It's called the IRS Tax Withholding Estimator. And I recommend that everyone goes in and you just check what is being withheld currently from your paycheck to what the government thinks you will end up owing in taxes. And this is powerful for a number of reasons, but it particularly helps you see how different withholding amounts can affect that refund or potential tax bill. You can also see the effect on your take-home pay and any taxes due. So I recommend, again, using it to avoid surprises at tax time. And also that way you can adjust your withholding up front, ensuring there's a bit of a balance between your paycheck and your refund. It's totally secure and does not ask for any personal information. And there are also other similar calculators on platforms like TurboTax, NerdWallet, and HR Block, just to help you fine tune your withholding. Again, I think this is like a super critical piece of tax planning that often gets very, very overlooked. Next slide, please. And so once you kind of understand what you're paying in taxes, I also recommend taking a look at how you're paying taxes. Because honestly, I think a lot of people, they log in, they put all their stuff into TurboTax, which is totally fine. And then they don't look at it ever again. They just like, all right, the government accepted my return, we're good. And they keep it moving. But there's actually some complexity to our tax code. We have what is called a progressive tax code here in the US, which means that I like to think of it as a staircase. So each tax bracket is like steps on the stairs. So as your income increases, you go up a step, and that amount you've increased your income is taxed at a higher rate. But not all of the other stairs. All the other stairs are taxed at those lower brackets. So that 12% that you see here in the diagram on the screen, again, it is taxed incrementally. There are those two rates that tie into this. The marginal tax rate, this is the easy one, is that one on top. It is the percent you would pay on $1 more of income that you earn. So another way of thinking about that is that it's the rate that is applied to the highest income bracket you fall into. It's at the top, you make $50,000, it's the 22% rate tax bracket, and that's, your marginal tax rate. If your income falls within the 22% tax bracket, your tax rate is 22%. The more interesting one to think about, and also where a little bit of math comes in, is thinking about your effective tax rate. And so the effective tax rate is the average rate at which your total income is taxed. Or, another way of thinking about that is the percent your taxable income that went to that tax rate. So, here we can see of any dollar earned for this taxpayer between $0 to $11,000 is taxed at $10,000. Any dollar earned that is between, $11,000 to $44,000 is taxed at 12%. And so that is, again, just a more interesting way, I think, of looking at the way we pay taxes. The effective rate accounts for all those deductions, credits, and the progressive nature that the other two slides were kind of talking about. And I also like to point out to people, it's often lower than your marginal tax rate because it reflects that blended rate across all your income, not just the maximum amount you're paying on top dollar. And so one thing that directly does impact the difference between your marginal tax rate and your effective rate are those deductions. So like your student loan interest, your mortgage interest, charitable contributions, any of those itemized deductions would change this, and tax credits as well that directly reduce your tax liability. These types of adjustments, again, lower your effective rate compared to your marginal rate. Yeah. And so once I think people have understood, a little bit about your tax picture, that I think sets people up to have very robust personal financial foundation. Once you understand where your money is going and and what's coming in, that sets you up again to have this broader base that you can build from with investments and all these different building blocks in your financial picture. So one of the essential components of that financial foundation that we talk about all the time, not just in my line of work as a financial planner, but just every day as a young professional who's examining personal finance, is understanding spending habits. It sounds so basic, and I remember thinking about this in my early 20s when I first graduated from George Mason. When people told me this, and I was like, "Oh yeah, I know exactly what I spend." But by understanding where your money goes and keeping an actual record of those expenses, including small purchases, then it helps actually really control and then build something that is called a cash flow. And so understanding cash flow is super important for going in any other direction with the financial plan. So we highly recommend it. I know most people today, like probably seen like with their bank apps, they have, little summaries at the end of the year, but I recommend taking a look, at least a few times a year, hopefully monthly. Some people can do it on a quarterly schedule, but there are plenty of tools out there that are budgeting apps or spreadsheets that can help you track these expenses. And then with the kind of tracking is categorization. Categorization is that grouping of expenses into categories that is so pivotal because it helps you identify patterns and trends. Um, and then, so once you have that kind of tracking and cash flow understanding developed, then it's time to kind of build a budget. And that budget projection is a financial roadmap in itself. It helps you compare your income to your, necessary expenses, your rent, your bills, your mortgage, and then allocate the remainder to, all those other building blocks in your foundation. So an emergency fund, debt repayment, discretionary spending, the fun stuff. And yes, and then so once you have those kind of building blocks in place, then you can move on to more advanced goals such as saving for retirement. Um, I consider retirement, an allocation-based goal, which is what we call, kind of the next step for building upon your financial foundation. Once you kind of have your budget and your income and expenses all mapped out, then you can really get into planning for the future, which is exciting. And so with retirement savings in particular, we'll touch on this a little bit more as we go in this presentation, but you have time as an ally. And so that's why it's important we say to start early. But yeah, and then other specific savings goals that can be allocated are those short-term, midterm, and long-term goals. People tend to break them up like this just because it helps also if you want to invest for those goals to have that timeline in mind. As you learned earlier in this presentation, that timeline affects what you might be invested in. So very, very helpful for building upon your financial foundation. And with those invested accounts that are goal specific, that's when you can really get advanced and start thinking of your time horizons and your risk tolerance for investing for those goals. And so once you've got this robust financial foundation, then you can kind of move into other topics. So you've got your emergency fund, you've started saving for retirement. And one of those topics that obviously is very important is insurance. Insurance planning is a super crucial aspect of financial security. And as I'm sure, most people are very familiar with some of the examples on this slide. But there are quite a few options within these different categories. There are different types of coverage. And I think it's really important to kind of review that and be aware of the different options available to you as someone who has insurance. Health insurance, I know, is a very basic one, providing coverage for your medical expenses, doctor's visits, hospital stays, and prescription drugs. It is essential, obviously, in this country to protect yourself against unexpected health costs. Simply can't go without it. Another one we have on here is auto, which is mandatory for vehicle owners. So for everyone who is driving on this call, you should at least be a little more familiar with this, covering damages to your car and liability for injuries or property damage caused by your vehicle. Home and renters insurance protects your home or rented property against damage, theft, and liability. Another one that's pretty mandatory, but I think what people overlook is how many different types of homeowners and renters insurance exist. Those are those HO policy documents. And I do recommend for people who are even if you're renting, your first apartment, still take a look at that renter's insurance and make sure you know what is covered and what the amount is covered up to. I think it's fairly easy to kind of be like, oh, I need this. You go online, fill out the first, application with the first company, you get it in place. It auto drafts out of your bank account, and then you never think about it again. But I think it's really important to take a look at that, because some people in their apartments, you might have your computers, you might have very expensive, electronics, and things that might be worth more than what your coverage actually is. And so I, again, very much recommend reviewing um, that type of coverage. Some that people are less familiar about is disability insurance. I always advise people who are starting a new job to ask their potential employers about this, just because this is something that would replace a portion of your income if you were to become disabled and couldn't work. Disability insurance would then kick in at some point, and there are a few different tiers and levels to it. Um, Depending on your occupation, but I do recommend people look into that, and because often it is employer sponsored or employer offered, and then you can buy it to go with your insurance plan. For anyone who is self-employed, absolutely, definitely encourage looking into it, because it again would replace income that you rely on. Life insurance, again, fairly self-explanatory. There are several different types of this. And I just, again, recommend that people who are looking into purchasing life insurance are doing so by getting multiple policies, or evaluating different options, just because there is so much there. And again, it can be very, very specific to your financial goals. One other one that is not on here, but I did want to mention because it's one people don't talk about, I think, until you really need it, is long-term care insurance. This one is to cover costs related to nursing homes, assisted living, or in-home care for elderly or disabled individuals. It kicks in after a certain amount of time, and it can end up being very, very helpful with expensive healthcare today. And so that one people tend to look at in like around their 40s and 50s, look into purchasing, and then it can kick in your elder years, and be increasingly valuable. And it's one I personally did not know about until I started working in financial planning. So just wanted to add that as well. Nick, I think I'll turn it back over to you as we kind of discuss other building blocks of financial planning. But again, just my last note on insurance is that we recommend revisiting those policies periodically, and for any life changes, just like tax.
Thank you. All right, so moving on to estate planning. So estate planning pretty much entails planning for, if you become incapacitated or when you pass away. And so some important things to consider whenever you're setting up any type of account are having beneficiaries. Essentially, this will help your accounts avoid probate. And what probate is when you pass away, if you don't have anything in a trust or have beneficiaries assigned, it pretty much goes through court. And then from there, it'll be determined where those assets go. And it can be a very time-consuming process. It's not fun, and it puts things on public record. So having a beneficiary for, say, your investment account, if you have a 401k, you have a beneficiary on there, and say if you do pass away, it'll go straight to that person. You don't have to worry about, dealing with the court. It'll go straight to them, which is a plus. And then for titling assets, say if you have a brokerage account, if you don't want it in a trust, one thing you can do is do something called a TOD, which is transfer on death designation. And essentially what that will do, pretty similar to a beneficiary, allow you to have a beneficiary and transfer it over. There's other things such as JTWROS, which essentially there's different variations of this, but pretty much you can have a joint tenancy set up, say, with your significant other. So if one passed away, the survivor would take over that asset. And so another thing to consider is potentially creating trusts. And one thing you can do with trusts, which is neat, is when you pass away, say if you have a significant amount of money, you have an 18-year-old, you may not trust them with a large sum of money. So what you can do in a trust is be able to dictate, how much money they can take or whether or not you really want them having anything at all. This is very ground level stuff with estate planning that I didn't want to get too much into it because it can get pretty complicated. So I definitely recommend consulting with an estate planning attorney in order to learn more and to get things such as, your will done properly, having medical directives and powers of attorney. Essentially, with a medical directive, if something were to happen to you and you can't make a decision for yourself in a hospital, having a directive will aid in being able to have a person help guide those decisions to be made. And it's kind of similar to powers of attorney. Say if your mental state, you're not cognitive anymore, having a power of attorney will allow someone that you designate to that to control your assets if you don't have the ability to. And so having those are really important things as well, just because, if something were to happen to you and mentally you're not there, it'll allow that power of attorney, who should be a fiduciary, to make sure that everything in your finances is properly taken care of. And so, like I said, at least at the very least, I recommend seeing an estate planning attorney to at least get a medical directive, will, and power of attorney done, because those are really important things to get done. So moving on to retirement planning, we're not going to go super into the weeds, but just to give a broad overview of, retirement planning overall, you have different account types, and it's not limited to this, an IRA, Roth IRA, 401k, TSP. For an IRA and Roth IRA, that's individual retirement account. So that pertains to you. There's no matching to that. And so what's nice about a Roth IRA is if you don't have a 401k or something, you can contribute to that. Or if you want to, in addition to a 401k, you could have that potential to do that. And essentially the differences within Roth and regular is with Roth, you pay the taxes up front, and then upon retirement, you can take distributions tax-free. With an IRA, you don't pay the taxes up front, but you do get a tax deduction. And then from there, when you go to retire, you actually get taxed on your distributions as income. So if you had a 401k and say you pulled out $60,000, you'd get taxed on $60,000 ordinary income. And so there's more things that go towards that, but we don't want to get too much into the weeds with it at this point of time. But if you want to learn more, I definitely recommend consulting with a financial professional, a CFP. And I just, one last thing for 401ks, if you are starting out young and your money's a little tight at first, I recommend trying to contribute at least at the minimum the match. So a lot of times, a popular thing that firms will do or any companies will do is say, for example, they'll contribute up to 4% of how much you defer. So essentially, if you defer 4%, they will match 4%, which is nice. That's essentially free money you get, which is essentially kind of like a, per se, 100% return, even though it's not a return, it's them putting money into it. So I highly recommend doing at least the minimum. And when you do have a job, I highly recommend looking at the provisions of it, because every 401k is going to be a little bit different with matching as well as vesting. Some places have a schedule to where, depending on how many years you're there, is how much you actually get to keep of that match. So those are some important items to consider. And for distribution planning, that's more or less when you get to the point of retirement. A very great way to save for retirement is to do something called DCA, dollar cost averaging. And essentially, you do every month or every 2 weeks, you set up a consistent schedule of putting money into the market, kind of similar to a 401k, every paycheck, if you get paid every 2 weeks, put that money in and let it grow. And so that's a great way for it to grow. But when you do distributions, it's not as good, because dollar cost averaging captures the average of the highs and lows. You don't necessarily want the same thing when you're taking money out. So one thing that's recommended is typically looking at which assets are performing better. Because say if you get a year like 2022, when growth investments are down a lot, bond funds are still down, but not down as much. You don't want to liquidate more from the bonds, because if you liquidate something that's lower, it ends up hurting you more. So in essence of that, you want to be able to have a strategy to be able to look and not just take, allocation pools evenly from everything, but kind of look more at what investments are doing the best at that point of time. That way it can help preserve your retirement account for longer. And for tax strategies, there's things called Roth conversions and tax loss harvesting. Essentially with Roth conversions, what's nice about them is, say you hit retirement and you have a lot of money in a brokerage account that's not a retirement account, or just a lot of money in savings. What you can do if you have an IRA but you don't have anything in Roth is you'll be in a really low tax bracket, or if you're just living off of savings, you won't really have a tax bracket per se. Unless you're liquidating from a taxable brokerage account, then you'll have capital gains tax to pay if you have any gains. What's nice about that is you can take advantage of a lower tax bracket, pay the tax when you convert money from the regular IRA to Roth, and then from there be able to have that money appreciate tax-free. So when you go to distribute it in a Roth account, you don't pay taxes on it. And for tax loss harvesting, it's a way to arbitrage taxes in a certain way with investment performance. So say, you have two funds, a Fidelity S&P 500 fund and a Vanguard S&P 500 fund. They're two separate funds technically. You have the Fidelity one and it goes down a lot in 1 year. You sell it and then you buy the Vanguard one and replace. Given that, from what you've seen from research, they perform pretty similarly. I'm just using those two as an example. This is merely an example, not saying it is how it is. And so essentially with that, you get to claim a loss, even though you just bought it back and it's going to perform the same. But if you did that with the same security, it'd be a wash sale and you'd not be able to claim that tax deduction at all, or the capital loss from that. And so for goals in retirement, one thing that's important to consider is, you have your basic living expenses for, this is how much money I need to just get by. And then from there, planning on different things you may want to do in retirement, such as charitable giving, a new home, vacations, etc. Factors like that are important to consider. One thing that a lot of new clients don't even think about is, when you retire, you have a bigger home, you want your grandkids, if you have those, extra rooms for family to visit. But as you get older and your grandkids get older, you see them less, and having a big house is too much. So you may downsize or even move to another state. So kind of various items like that to consider to add on top of your basic living expenses to figure out where you want to budget towards. Then other items that are very important, things such as Social Security, pensions, Medicare, and healthcare. Say if you retire before age 65, you're not going to be eligible for Medicare. So, if you're in a range in order to get, or if you're in a range to where you can have COBRA to fill up that time, that's an option too. But for those types of items, I don't want to go too in depth because a lot of this stuff at the end of the day is very personalized. Online, you may see a lot of things, not just for retirement planning, but investments and anything else that we talk about in this presentation. Everything's going to be a little bit different for everyone. So that's why in financial planning, we like to say there's no like blanket statements that are necessarily true for everybody, because every person has a different situation. And so, I definitely keep that in the back of mind when you're looking through things online. If you're doing research, is to keep that in the back of your mind and, not hesitate to consult with a financial professional. And so kind of going back to what I was talking about a little bit earlier, with 401ks and IRAs, a lot of times they're known as tax deferred savings accounts, because when you place trades, because if you have a regular brokerage account and you're placing trades, you'll have to pay capital gains when you do different transactions or have capital losses. In these accounts, if you make trades, you're not paying any taxes on gains if you have any, because you pay the tax when you take the money out, or in the case of the Roth, it is when you paid the tax up front already. So that's not a factor you have to worry about. And another thing to consider with 401ks and IRAs are something called RMDs, required minimum distributions. They're based on tax tables by the government. As of right now, they keep changing it with the new Secure Act 2.0 provisions, and will probably change in the future. Right now it's 73, or if your birthday was, I believe, don't quote me on this, like 1960 or later, it'll be 75. Essentially, it'll be a set age once you're at that point. And the whole purpose of RMDs is the federal government wanting to collect tax revenue from your 401k or IRA. So based off of timetables and how much you have, will ultimately, deem how much you have to withdraw from your account. And going back to earlier, what I was talking about with Roths, one advantage is you won't necessarily have to worry about that too much if you do Roth conversions, because it can lower your RMD amount if you take it from your traditional account and move it into Roth. And, pretty much covered beyond Roths there. And one important thing to keep in mind is you got to be age 59 and a half to be able to withdraw without penalty. And there are other provisions with these accounts to where you may be able to take distributions for a little bit, but you will have to pay tax on it. For situations like that, if you do need to take money out, I recommend consulting with a financial professional to make sure you're taking the best route possible. And I'd like to thank everybody for attending. And if anyone has any questions for Nicolette and I, will be more than happy to answer them. And you can pop on the mic or send it in the chat.
Looks like we got a question in chat. What factors should we consider in looking at or hiring a financial planner or professional?
That there is CFP. Not saying that to be biased, but as someone who recently passed the CFP exam, one thing that really stands out with CFPs is they're not, a lot of other advisors, which isn't a great thing, because being a financial advisor can be a very loose term, because you can go to, 5 different ones and they do things a lot differently. But the CFP, it looks at all these different factors and looks how to weave it in, not only in just a general way, but specifically for you. So I'd say, like, general rule of thumb, I'd say start with looking at CFPs. And a lot of places will have like free initial consultations. So I'd recommend, doing those to kind of get a feel for the advisor, because you also want to work with someone that has a personality that matches you. Because if that's not working, then you're not really going to want to talk to your financial planner. So I'd say that personality aspect is important too. I don't know if you have anything else to add, Nicolette.
Yeah, no, I think Nick covered it with the CFP is the Certified Financial Planner designation. It is considered kind of the gold star of the industry standard. However, as Nicholas also mentioned, the term financial advisor can be a very loose term. As we just covered, there are investments and insurance and estate. There's a lot of different pieces that go into financial planning. And I think that is an important question to ask of your financial professional is, are you a CFP? And then also asking them what other licenses and accreditations they might hold. Just because, again, some people specialize. So again, I have a tax specialization, so I'm also an enrolled agent. But some people go into an investment specialization. And there is a quintessential, there's a lot of alphabet soup, but again, that's kind of, I think, the best starting place is looking for a certified financial planner, just because then you know that you are working with someone who has spent a lot of time kind of studying all of these different areas, all these different disciplines, and will be able to work with you, on a multitude of different topics, not just, insurance products or not just annuity products, or so to speak.
Yeah, I definitely err on the side of caution if you do go into a consultation and someone's trying to push products on you or only talk about investments and how great their performances. Because if someone was really that great at investing, they'd be living on an island because they know how to play the market. So I'd say,
Yeah.
I'd say it should be more of a casual conversation, and then it should feel natural. It shouldn't feel like a huge sales pitch, I feel like would be a good way to put it.
Yeah. Oh, also, okay, last plug for the CFPs. The board should be sponsoring this really. But CFPs are fiduciaries also, so they're obligated to do what is in the best interest of a client. Salespeople for mutual fund companies or insurance companies are not. So just something to also consider.
Thank you both. I think that is some very valuable takeaways. We have another question. What are the best practices that young students should follow to start managing their finances and create a strong foundation?
I love this one. I'm happy to jump in, and then Nicholas, as a more recent grad, might be able to chime in as well. But we mentioned in our presentation, this two-part of building a financial foundation and then building upon your financial foundation. So I highly recommend starting with building one. That includes understanding, certain spending habits, understanding income and expenses. So a really easy, free way to start is by just looking at your bank account every month, and kind of going through and reconciling your income versus expenses, and then jumping into that categorization we were talking about, and just kind of creating categories so you can see where your money is going. You can see and set reminders for certain, annual, semi-annual, or monthly payments. But I think that's a really important place to start is the understanding and tracking spending. And then also creating a budget. I hated this one when I was fresh out of college. I work in financial planning, so I heard it a ton, and I resisted it a lot. But that kind of discipline, of creating that budget, allows you to see, and understanding your cash flow. It allows you to see where your money is going. And then it also allows you to take control of your money and tell it where to go. And I think that is really powerful. Because like I started saving I bought a house 2 years ago in Northern Virginia, and I was able to do that because I had a very disciplined kind of savings goal, and I also invested that money. So I started looking at my budget, I started putting aside what I could, and then I actually invested that money into the stock market. And I invested it fairly conservatively because I knew it was on a 2 to 5 year time horizon. But that's a great place to start again, is the tracking, and understanding of your spending, and then going to your budget. And then, kind of the more advanced level is starting to allocate your savings.
Yeah.
Nick, anything else?
Yeah, no, I agree with all that. I know I personally don't use it. I have some friends that use an app called Rocket Money. I know there's a lot of other apps like that where it helps you track your spending and everything, but you know, making sure you don't spend more than you earn, like it sounds super simple, but sometimes in life it's easy to get caught up in different things. And, one thing that's tempting is, when you start making money is all these different things I should buy. One thing I personally like to do is, you know, I love Excel, so I build everything out through Excel. Other people can't stand it, which I can understand because sometimes it can be a pain. But I'd say, for me, what I like to do, I'm a little weird. I like having everything kind of spaced out. I like to have two bank accounts, and typically, depending on whoever your pay services with your company, like there's Paychex or Paycor. I think most of them, they'll let you allocate however much money you want into whatever account you want from there. So what I like to do is I personally use Capital One's high savings account because they pay like 4.35% right now. Don't quote me on that, but they have a really good yield payment for it. So or a good interest rate. So for me, I like to have some money wired towards there. That way I don't even have to manually do it. It just sticks in there for savings. And then my other savings account with my other bank, I have that for emergency funds. Pretty much build that up until it's at a level where it pretty much covers at least, 6 to 12 months of expenses. And then from there, have one checking account to where I move money into investments for extra savings. And then that my other account is money that is sent into it that is free to spend on whatever I'd like. So I'd recommend, if you do have a brokerage account or something, trying to have because I feel like it's easier if you have your pay provider to send it automatically from your paychecks than for you to manually do it. With 401k plans, if you're participating, it just comes out of your paycheck and then you get the pay. So I'd say being able to streamline stuff makes it a lot easier because for me, I don't always have to look at my Excel sheet constantly or always have to constantly update it. I just use it to set a budget. And then from there, I can just look on my spending account to know how much I can spend. And I'd say for me personally, it makes it a lot easier to know that because if you just have one account with a lot of money, you'll have to try to mentally visualize or calculate in Excel or whatever application, oh, how much can I spend? So if you just have an account that's dedicated to, spend on whatever, I think that'd be a smart thing because you don't have to do calculations. It's just right there.
automation certainly helps with consistency, and my unsolicited comment would also be that attending fun things like these where you get to learn about financial topics can really be a way to help you build that foundation too. So you're already taking some good steps to familiarize yourself with some of these concepts and topics. So I'm not seeing any other questions in the chat. So I would just like to thank you both for this excellent presentation. This was very valuable. And I'd like to thank everybody else for attending our final Money Smart Day session of 2024. The recording will be posted on the Money Smart website, moneysmart.gmu.edu. So you can always check it out if you want a refresher. And just extending the biggest thanks to our speakers. I think you guys did an excellent job tonight.
Thank you.
Thanks so much for having us, Taylor.
I hope everyone has a great night.